Welcome to the daily update. This is being prepared Monday, September 26th, where we'll look at the action in the market today and then see how things look for Tuesday, September 27th. And we had another down day, down a little bit over 1% with the S&P. We continue to be oversold, specifically in the short term, intermediate term, and we're even seeing a few of our long term indicators starting to give us an extreme negative reading. Doesn't mean we necessarily have to stop here, but at the beginning of the day, it looked like, okay, maybe we're going to get some kind of a bounce. The NASDAQ was up pretty strong, up over 1%. Well, then that turned around and everything started to go back down, and we ended up being down on the day because there's a lot of cross currents in the market right now, and I'll try to point those out as we go through this. So right at the open, we had a slightly lower open. It wasn't a real big change, and we saw some initial buying, and it looked like, all right, here we go. Maybe we're going to get a bounce. We were not even able to get up to R1 at 37.41. As the day went on, we saw selling enter the market. We went down to the unchanged level. We dropped below that. We even went slightly below Friday's low at S1 at 36.51. This is kind of encouraging, though. Prices did try to go lower, but that level around Friday's low and around S1 ended up giving us some support for the session. Now, we didn't see this early weakness, late day strength pattern that we've been seeing lately, but there's some other things that are starting to show some improvement. We're seeing a little bit of an improvement with our sector rotation, and we're starting to see where a real convergence of sentiment and oversold conditions all happening at the same time. And that might suggest we get some kind of a bounce. Now, what kind of a bounce is that going to be? It's really difficult. I know there are ways to measure this and look and all that stuff. I just follow the charts. We just evaluate things on a day-by-day basis. And if they start to improve, we just make note of that. And then when it looks like we might top out at some kind of resistance, okay, then we just be aware of that and watch for that. And then we might be over as far as some kind of a bounce is concerned, or it might lead to something even stronger. We're also seeing real cross currents as well, because you have the Fed out there who is trying to get a handle on inflation by raising interest rates, but yet that's Fed policy. Well, then we have fiscal policy coming out of DC that's adding all this stimulus and all these programs and everything into the economy, and that's supposed to help the economy grow. And so they're kind of battling each other right now, and that's why you have a really confused market. That's just part of it anyway. Going into the close on Monday, we did see some recovery, not a real strong recovery, but when we closed with the S&P, we did set a new 52-week low. We ended up being down 1.03%. Volume was above average. Our technicals are negative, but we're showing a real extreme negative reading right now. So going on the short side, unless we really break support and look to be able to close below that support, that might be a little risky right now. You don't necessarily want to go long because everything is pointing down. We can't really go sideways for the time being because we're really bouncing around and the market is showing a lot of movement right now. This is a lot of it is coming from the inflation and interest rates, not only domestic in the US, but we're dealing with this on a global basis. Specifically, the big kind of story was in Britain, and I have a chart of the British pound to show you, but that's a lot of the different dynamics that are really coming into play right now. So what are some comments? It did look like we were going to get a rebound at the early part of the day. The NASDAQ was up over 1% and ended up giving that up. And then here's kind of some convoluted messaging about what's going on internationally. They're being influenced, stocks and bonds as well are being influenced by currency movements. We've got the dollar just going up really strong. We have the Japanese yen, the euro really going down. Well, now the British pound has kind of come into the whole scheme of things as well. On Monday, it fell to an all-time low against the dollar. So if you want to go to Britain, and if you can afford it, it's a pretty good time to get a healthy exchange rate if you want to change dollars into the pound. And then some announcement came out where it really recovered big time. I mean, it moved 6 cents after this announcement came out. The idea was that the Bank of England would step in with an emergency rate hike to support the currency. Well, then they came out and said, we won't look at this until our next meeting, and that's going to be on November 3rd. So that sent the British pound back down. And then US bonds also fell in reaction to rising yields. So we have bond prices going down. We have different currencies in the world going down. We have the dollar going up. That's producing a lot of headwinds for stocks. And it's also feeding over into the earnings per share for companies. The stronger dollar doesn't make their balance sheets look as good or their earnings reports look as strong. Then the dollar strength continues and it's now outperforming oil. Now, this is interesting. Oil has been in the lead for 2022, but I don't know how long this will last, but we're actually seeing the dollar outperforming oil currently. And I have a chart to show you that. Many indexes are hitting 52-week lows. Not all of them. We have the S&P hit one. We have the Dow hitting them. We have the transports. But some of the other indexes are close, but they haven't quite set new 52-week lows. Stocks are short-term, intermediate-term oversold, with some long-term indicators also giving us oversold indications, and I'll show you those. The 30 to the 5, the 10 to the 2, the 10 to the 5. Those yield curves still remain inverted. Sentiment is getting a little bit more fearful. We're starting to get to more of a critical mass type of reading. We didn't have any economic reports that came out, and our trend is negative, and we're above 20. The ADX is going up as the S&P is going down, so we are in a negative trend. Our bias, naturally, it has to be negative with the down day, and over the last number of days, our momentum is also negative. Let's go back and talk about the day's session. Here, we're seeing a real tipping now. We're under 25. We dropped under 25 after Friday. We're dropping even more with our fear and greed index. And here's the historical chart. We're seeing if at some point we might hit some kind of a bottom and then turn back up. Here's another sentiment indicator that we look at from Goldman Sachs. And as this black line is going down, this is just showing that fear is increasing, and we're starting to get into this standard deviation of minus 1.5. We're getting down to a pretty extreme reading, but it could still go lower than where it's at right now. Another sentiment indicator is also starting to tip a little bit more over to the left, which I would put this as red, but they should choose to use green because that usually is contrary buy. It's also really starting to tip over and show a pretty strong fearful environment. Another thing is the latest reading with the RIDEX bear bull ratio, and this is as of Friday. Actually, it might have been as of Thursday. There's a lag in the delay here, where folks are starting to favor more and more of the bearish mutual funds that RIDEX has available. We could still spike up higher than where we're at right now, but we could also call this a spike if we start to see a rebound in prices. Some Isabel net charts. This just shows the cases of inflation when it's above 5%. And how long did it take them to get back to 2%? That's what the Fed is trying to do. They want to get inflation back to 2%. Well, good luck with that. If you can see kind of over here, 4 or 5 from the right, this is the US and how long it took, about 5 years to get back into the 2% category. Where Greece, man, it took a long time. And then just different countries over the years when they've really had to battle inflation and what it took in the terms of length of time to get back down to that target of 2%. So here it says, once inflation is above 5% in advanced economies, that would be the US, it takes an average of 10 years to drop below 2%. I think a large part of this is Greece because they had real problems there, and they still do to a degree. They're kind of throwing this average off a little bit, but still, That could take some time. Also, looking at the valuation of real rates. Now, this is the rate of the 10-year inverted with inflation thrown into the mix. So when we look at rates going up, really this chart should be going up, but they have it inverted, so it's going down. And this is possibly posing a risk to stocks because interest rates are really going up and stocks are going down. And we've been seeing that now. We're in that kind of an environment where rising interest rates are really hurting stocks being able to recover or bounce. This is the G4. It used to be the G5, and now it's the G4. These are the balance sheets. It says they're still larger than in early 2021. So even though they're starting to come down a little bit, the G4 central balance sheet here, it's still just a little bit above here as a percent of GDP. But this is showing more of a global slowdown overall, but it's still hanging in there for right now. Then this is abnormal long in US markets. Now, ROW, that's the rest of the world. That's an acronym for that. It just shows that when you take all the different stock markets in the world, folks in the US are in stocks a lot more than folks are in stocks in other countries. Here, this is risks tied to real interest rates are tilted to higher for longer. This is just Goldman Sachs coming out and saying that they see real interest rates, again, taking into account inflation, that they are going to continue to go up, and they're forecasting it even higher at Goldman Sachs. Here is a thing called passive funds, and I try to explain this a little bit every time we see one of these charts. Passive funds are index mutual funds like the S&P 500, the Dow, the NASDAQ 100, where you just put your money into this mutual fund and they just trade whatever stocks make up that index. Well, there's no choices that have to go into that, so that's called passive investing. The alternative to that is actively managed mutual funds, where you have a money manager that goes around looking for different investments, tries to buy the right things at the right time, and then sell the right things at the right time. Well, when we're doing really well, studies have shown that passive investing tends to do better. When we're having trouble, active investing tends to do better because the money managers have more flexibility, where you just have to ride the index. If you're passive investing, there's really not much that can be done to adjust things. Well, this just says that passive funds have captured 376 billion so far in 2022. It's lower than it had been because 2021, that was a good year to be in passive mutual funds. And it is increasing overall, but is it going to continue? And then we saw some problems here back in 2019 and in 2020 as well. This is just where they rank so far throughout the year. In the last video, I talked about initial jobless claims, how they have kind of spiked up a little bit, but they're still lower when we compare them to previous years. Well, these are continuing jobless claims, folks that are still on unemployment, and this is coming up a little bit, but it's still lower than when we compare it to recent years. Then this just shows the yield change. We're just seeing interest rates spiking up right now, and this is showing how interest rates continue to go up even more. They're really shooting up. Are we due for things to settle down a little bit? Maybe for interest rates to come down slightly because they've just been going higher and higher and higher. Well, markets have a tendency to overreact. Everybody starts talking about it, and that's usually about the time when it's done, at least in the short term. Then looking at the session during the day, one thing that's interesting, even though everything was down, look at how value really was down a lot more than growth. And that has helped some of our sector rotation charts to improve slightly. The VIX is finally starting to get some legs and go higher. Remember, when the VIX is high, it's time to buy. And the bar chart is also going up. Now, we could go higher than where we're at right now, but we're finally seeing some real fear coming into the market as far as the VIX is concerned. And the VIX of the VIX is really spiking up because the VIX is finally starting to move. So that's really spiking this up also. And we're also getting to a point with the RSI going over 9 periods where we're getting extreme up here. So maybe the the VIX is it's gone up too far too fast. Now, we could still go higher than this. We've done that before, but this is just a warning sign showing that at some point we might see exhaustion to this fear, and then that might help support some type of a rebound in stocks. Fear continues to go up as we go down. That's what the Ulcer Index measures. The mass index getting nothing here, but we're just watching this. We're down 24.15% from the all-time high. And if you look at this closely, where I have this red bar, you'll see that we did set a new low if you go back 52 weeks now. And that's not positive at all. But the fact that we're still holding right around this level could still provide some kind of base to build up out of. We saw a real decline in the equity put call ratio, at least on the 1-day chart. It really spiked up on Friday. Well, it was still high, but it came down in Monday's session. But now we're starting to generate a new signal here. We're getting back up above this 0.8 reading, which oftentimes this is a signal, one of the possible positive scenarios that we look at. Now, this could still continue to go up even more, but we're in that area where we really want to watch this chart. And I have the longer term chart later to show you. Here are the pivot points for Tuesday's session. And we're coming down to this level. And so far, this support level is holding up. We're really close to it right now. We could break down below that, and probably this is what I've seen. Don't be surprised if we do break down below this, especially early in the day. Why? Because there are probably millions of stop loss orders triggered right here. And that's a common trick that is played where price will come down, kick out all these stop loss orders, take people out of the market, and then boom, turn around and go the other way. Just something to be aware of right now. Then here are the pivot points for the month of September, all the different ways that they are calculated. We're coming back down on our short-term chart where we want to see, can this support hold? Now, this is many hours before the market opens, but right before I started recording, the S&P futures were up over 1%, but they've been up over 1% before, only to go the other way by the time the market actually opens. So we'll have to see how things play out. There's an intermediate term fib chart just showing we're still trying to hold this support level. Longer term, and I extended these lines over, where can we hold the support on other fib charts? If we break down, then we're going to come down, at least on this chart, we have the potential of coming down 50%, which would be at 35.09 or 35.10 in that area. The weekly chart is also continuing to show weakness, but we're still holding up as far as support is concerned. We may come down to this moving average, or we could come down to this 50% retracement as well. We're starting to drop below the trend channel, at least the midpoint here, but we've done that other times before, only to bounce back up. So it doesn't mean it's necessarily the end of the world. Are we weak? Yeah. Are we going down? Yeah. Could things get even worse? Yeah. But other times when we've been in a similar situation, sometimes this marks a type of rebound. Looking at our sectors, we had 10 out of the 11 being down, led by real estate and energy. Energy's just been getting hammered lately. Utilities are also starting to show some weakness currently, but it's just pretty negative all the way across. But utilities, even though their scooter score is dropping, they're still in the 90s. That's about the best looking chart right now, but it's even showing some weakness, with communication down in single digits at 7.6. Here is, and just remember, not too long ago, this sector was up 30, 35%. Now we're up 19%. Still a respectable return, but if you got in at the top thinking that energy was the place to be at that time, you're seeing some pretty hefty losses right now. Utilities had been doing a lot better. They're still positive, but they're giving back a lot of the gains that we saw. And then all the other sectors continue to really struggle. Communication down 37.67% since the S&P hit its all-time high. Here are all the different indexes and how they are performing. Technical alerts, kind of a mixed picture where the euro set a new 4-year low. And then real estate, it set a 4-year low with the ETF. NASDAQ went above 10.9. Then it got above 11,000. That was early in the day. Look, we were getting some real strength from that. The S&P got back above 3,700, at least for a while there. And then we see some other ETFs and sectors starting to make 52-week lows. Here's a 2-year low with the communication. The Dow with a new 52-week low. The NASDAQ went down below 10,008. NYSE is giving us a BPI below 20. See, these are, when we drop down below 20, these are extreme negative readings. And this is all kind of putting things in the perspective of we might see a convergence of all these negative things coming together, which often marks a bottom of some kind, or at least some type of a rebound. And then at the very top, we have the dollar just continuing to set new highs. It's a 4-year high here. The Dow, see how it's coming up slightly? It's still a really bad score at 58.7. We want this in the 80s and 90s to be really healthy. But see how this chart has been showing some improvement. The S&P is in second place, also showing some improvement. Mid caps are still continuing to show more weakness. Small caps kind of flat, and they're just really having trouble as well. And the Qs are in last place, but they're starting to show some improvement for their technical charts as well. All right, let's look intraday here. We didn't see much of a change from Friday's close to Monday's open. And then this is the positive side of things right after we opened, but then that just didn't last very long. This dashed line here is that's the unchanged level. We came back down to that. We broke below the daily pivot, went all the way down to S1. And this was kind of the moment of truth right here, because we were getting back down to Friday's low. We tried to go a little bit below that, tried to go, but it held eventually. And then we did see some recovery going out of this, but then a little bit of weakness going into the close. And then we ended up having a red bar right at the close. So yeah, there was some improvement, and things could be coming to the point where the smart money is coming in later, but it's not as obvious as what we were seeing, for instance, in Friday's session, the nice little bounce, in Thursday's session, way back Tuesday of last week, late day recovery. We cross off Wednesday because that was the Fed day. So it wasn't as blatant as it has been. Looking at our trend, the ADX is still going up. It's above the moving average. The red line's on top, and so that is a negative trend. The Arun continues to be extreme, even though it was flat in its reading, showing that sellers are in control, buyers are not really to be found yet, according to this indicator right now. Looking at breadth, we still continue to show weakness based on price and volume, and this is not very good looking, but a lot of times this is capitulation type of readings that we see. Advanced decline ratio, it's also getting extreme negative. We haven't seen that in quite a while. Well, we saw it a little bit back in June before we saw the nice little bounce up. Well, we're getting an even lower reading than that currently. The new highs, new lows didn't expand as much as it did on Friday, but we're still seeing the 5 period going down and the 10 period going down. Accumulation distribution is finally dropping below the moving average. Short term, you'll see a lot of oversold here. Here's the 1-day advanced decline ratio, just a little bit into the maybe we overdid it phase. Going back 5 periods, we're extreme to the downside. 10 periods, extreme. Stoke RSI, extreme. Williams percent R, extreme. Force index, extreme. Swindlin trading oscillator based on price and volume, extreme. And I'm meaning negative by this. And look at how the McClellan oscillator just jetted lower. That's a pretty extreme negative reading. Our moving average study, extreme with the 20, 50, and even getting extreme with the 200. Our stochastics, they just are pegged extreme on all the different time levels that we look at. So can you see where we're pretty short-term oversold? Now let's look at the intermediate term. We're starting to generate a new signal. This is one of our possible positive scenario charts where we're really getting down with the 19-day exponential moving average of the advanced decline ratio. It's getting extreme based on price and volume. And then you can just stop this and look. When we had similar readings to this, what happened after these readings in the S&P 500? A lot of times this provided real support for prices to go higher. Standard deviation's coming down a little bit, but it's still rather high. This is how far away are we from what the median or mean price should be right now. Then rate of change 20 period, even though it bounced up a little bit, we're still extreme. The Sean trend meter is extreme. The PMO continues to decline across the board, also based on price and volume. With our PMO studies, extreme negative with those PMOs that are rising, buy signals extreme, and those that are above zero getting down into an extreme reading. Chaikin oscillator still is declining. Chaikin money flow also showing weakness. Volume is still picking up from where it had been. The vortex is still negative overall, even though we saw selling come down slightly, but when the red line's on top, it's negative. Summation index based on price and volume continue to be negative, and we're getting back down to a point where at other times we saw some kind of a short term, if not an intermediate term, bottom with the summation index based on price, but we're really showing an extreme reading based on volume. The slope indicator finally said, okay, I give up. I'm going to go negative now. And that means that all of our oscillators are pointed down. BPI starting to get extreme negative here. Ease of movement ticked up slightly. Ultimate oscillator continues to be negative. Money flow index, not extreme negative, just declining. CCI 14 extreme, CCI 20 extreme. RSI, now we're starting to see some extreme readings with the 14 period, and we've been seeing that already with the 9 period. Doesn't mean we have to stop right here, but it could suggest that we're getting close. The boom indicator also getting very extreme when we compare it to the 50 period moving average, but we're still declining when we compare it to the 200-day moving average. And here's our Dow Theory Chart. The Dow's making a new 52-week low. Trannies are actually outpacing the Dow to the downside. Utilities are showing weakness, but they're not back down to their low, at least yet. TTM squeeze negative and declining. Balance of power is kind of hanging around this middle line here. It actually ticked up slightly. And the CMB composite index, it actually bounced up a little bit too. It won't be a signal until we cross above one of these lines, probably the red line here. And then we confirm that when it crosses above the other line, but we're not near that. What I'm looking at is that we're seeing a pretty extreme reading now with this index. The Connors RSI, we don't see extreme negative readings here very often. Well, we're seeing one now. Different charts. This measures pretty much just trend. We are down with the Heiken Ashi and negative. We're down with the Kegi chart. We're down with the Renko chart. We're down with the 3-line break. And see how these things are kind of lining up with each other? It's actually a little bit below here with the 3-line break. No new zeros added here with the point and figure chart, but we're still working off a triple bottom breakdown. And our different trading systems, the Elder Impulse, yeah, red bar, negative for the S&P 500, as well as the SPY. The SAR continues to be on top. That's negative. We're in deep purple land with the go, no-go system. Now, long term, see how extended we're getting with our 50, even our 150, and maybe not as extended with our 200-day moving average study. Here's one that I did notice, the rate of change going back 200 periods, we're dropping even below where we were in June. So that could be an extreme negative reading. And we're getting down to the point where we were at the COVID lows. Just something to be aware of. On a trend basis, our special case still shows that we are down. Here are the diamonds, where they did make a new 52-week low, and they are kind of breaking down a little bit more than the S&P. Here's the Dow, where it dropped down below this pivot level, came up to this pivot level, but that acted as resistance. And here's the Qs, which are also still negative, but they are right on this pivot level currently, which is kind of interesting. The Vixen, which measures the volatility of the NASDAQ 100, it is finally starting to go up, but again, not necessarily as extreme as where we have been before. The NASDAQ, just a little bit below this pivot level now. And the mid caps, they're showing some more follow through weakness. The Wilshire also broke through support. So it's not like things are hunky dory here. Things are looking pretty bad, but we're also seeing a real coming together of a lot of things that suggest that we might see some kind of an attempt, at least, at a bounce. Here's the dollar, which is just going up. My goodness, it's up over 114 now. Here's the British pound to the US dollar, and just see how it's really been coming down and down and down and down. And it is off of its lows based on this chart, but still, it is pretty decidedly negative currently. This is not due to the Queen passing away. This is having to do with the economic situation in England. The S&P to the dollars, they still have a really strong inverse relationship. If one's going up, the other one's going down. Gold, which because the dollar continues to show a lot of strength, gold has really been suffering, as well as has silver. Oil is continuing to fall, and this is what the politicians are trying to do. They want gas prices down as much as possible as we get closer to the election. And the correlation between the S&P 500 and oil, they're both going down these days, so they have a pretty strong correlated relationship. And then this is the freaky one. I usually don't show this in the daily videos. Look at how oil has now dropped below the return going back to the beginning of the year against the dollar. The dollar is outperforming everything right now. And it's strange that this is happening, where we still have gold, stocks, and bonds down. Going back to the first part of the year, bond prices still continue to fall. Our world index continues to fall, and we're kind of leaving this COVID low in the dust right now as yields continue to go up. Here's the 10-year Treasury yield, which is breaking out currently. 30-year yield, which is just slightly above the 61.8% retracement at 3.72. This goes back to the 2007 high to the COVID low. And so this is a long-term chart here. And the fact that we're breaking above this is just showing again how interest rates are really going up. Stocks and bonds are having a tendency to go in the same direction now, which tends to be down currently. Our yield curves, no changes here. The 10 to the 5 is inverted and getting even more inverted. The 10 to the 2 is also becoming more inverted. The 30 to the 5-year, look at how that just jetted down there. And this is not normal. This is what should not be happening in a good economic environment. And to see all of this is just pointing a lot to the uncertainty that's going on. But we still have the 10 to the 3 month. That's actually coming back up a little bit. It has not gone inverted. Tech sector to the 10-year, opposite directions now. Interest rates go up, tech goes down. That's what's been happening. And we have the, my goodness, the 2-year and just screaming up here. It's paying the highest yield right now, which is just crazy, you know? But overall, interest rates are just going up, even though they're rolling over top of each other on the way up. Our scenarios, just to give you an update, I'm probably going to take this chart off because the Copic curve, we've lost that signal. We're getting extreme now with the 200-day simple moving average scenario. We're getting extreme with the 50-period moving average based on the S&P. the mid caps and the small caps. The 10-day average of the highs minus the lows also giving us an extreme reading. These could be new signals that are getting ready to generate. The broad market look at the highs minus the lows over 5 days, it's starting to get down more to an extreme reading. This is the one that I talked about at the beginning. This is a longer term chart of the 5-period equity put call ratio. See how we're coming back up above this red line? So it could be generating a new signal, but it could still go up higher than where we're at right now. The small caps really having a hard time setting another new 52-week low. Their small caps continue to underperform the S&P, so this chart is actually going down. We want to see this spike up because sometimes that will give support to the S&P 500, and that's just not happening right now. The S&P to the 10-year yield, they're going in opposite directions. Interest rates up, S&P down right now. Here's our sector rotation. A little bit of an improvement with the Q ratio to the S&P. Discretionary to the S&P turning up slightly, large cap growth to large cap value turning up slightly, and we actually came above the moving average a little bit. Here's the growth to value ratio with the large caps showing some improvement, mid caps turning up, and small caps looking better. Then the S&P to the 2-year having a real strong tendency to go in opposite directions as the 2-year just shoots off to the moon. And that's day after day, it continues to set a new spike. So once this tops out and comes back down, then this is when we will look at using this as a possible positive scenario setup. And utilities continue to do better than the S&P, so that's why this line continues to drop. Staples are also having some problems, but relative to the S&P, see how we're spiking up? We might come back and actually take out this spike and create a new spike, but we haven't done that quite yet. So what's our outlook for Tuesday? We are negative overall, but we are also oversold at this point. We have durable goods coming out. We have the FHFA housing price index, a lot of real estate and housing information this week, including the S&P Case-Shiller home price index. Consumer confidence will be coming out. And the geopolitical events, we're hearing more rumblings out of Russia, Ukraine. Hasn't seemed to really escalate as much as feared yet, but again, that could change at any time. Of course, all the situation in China with the continued lockdowns, there's some more sanctions being placed against China, but really the big focus is inflation and interest rates in the US as well as internationally, and then any Fed speak that may come out. So our scenarios, we have to go with the down scenario right now. Everything's pointing down, but since we're oversold, it's really hard to have a lot of confidence in that. We can't go with the up scenario because everything is negative, but we could be oversold and we might see some kind of a bounce, but we don't want to try to jump in before this actually starts to happen. And we can't really go sideways right now because the ADX is in a trend, and that's negative because it's above 20. So our conclusion, the S&P is negative, short term, negative oversold, intermediate term, negative oversold, long term, negative, but somewhat oversold with some of those charts that I went through. So thank you. I appreciate you watching this video, and I'll just keep a close eye on things, and I'll talk to you in the next video.